A wave of dumping began as algorithms overwhelmed the markets with a flood of sell orders. The price initially dipped, just as anticipated, but then it halted. Instead of plunging, it found an invisible floor. Suddenly, an enormous wave of buying strength surfaced out of thin air. The orders were so immense, they devoured the bank's selling momentum within seconds. Red candles turned green. The dip was met with an intensity we've never witnessed before. By the time the market closed, silver hadn't merely bounced back. It had burst through the key resistance at $67. This wasn't a routine price fluctuation. It was a flare in the sky, signaling that the infamous Friday smash, long considered the most dependable manipulation tactic in financial history, had officially failed. The predator is wounded. To grasp how critical this failure is, you must first understand the role of the villain, JP Morgan. They serve as the keeper of the largest silver stash in the West, while also functioning as its primary price suppressor. Their tool of choice? Naked shorting, selling contracts for silver they don't physically hold. They gamble on the price dropping so they can repurchase those contracts at lower prices. It's a ruthless game of financial musical chairs. But when you're short millions of ounces and the price rises instead of falling, you enter a catastrophic mathematical spiral. Every dollar silver climbs equals billions in losses for those short sellers. The inability to push prices lower yesterday has left JP Morgan cornered. They're now sitting on a growing pile of toxic debt. They attempted to bluff the market and lost. The market called their hand and raised the bet. They're stuck on the tracks, and the train is coming fast. Now we arrive at the unsettling possibility of Monday morning, though markets are closed for the weekend. Anxiety is already spreading in elite trading circles in London and Hong Kong, as the Asian markets reopen on Sunday night, Monday morning in Asia. The chances of a price gap higher are very high. A gap up occurs when no sellers are left at the current level. The price doesn't inch upward, it leaps. We could see silver jump from 67 to 70, and then to $75 in a flash. For the banks that are short, this is a nightmare scenario. Margin calls will be triggered, forcing them to inject more funds to cover their deteriorating positions. If they fail to provide the cash, the exchange will forcibly close their trades, compelling them to buy silver at any price. This unleashes a short squeeze. We've seen this happen with GameStop, we've seen it with Volkswagen. But this time, it's not a company's stock, it's a vital industrial metal. A short squeeze in silver could shatter global supply chains. The collapse of the Friday smash confirms a single critical truth: the physical silver market has finally broken away from the paper market. For decades, silver prices were dictated by men in suits trading digital promises in New York. But yesterday, industrial buyers, Samsung, Tesla, Apple, along with China's solar manufacturing giants, stopped paying attention to the paper price altogether. They've come to understand that the paper price is fiction. Manufacturing requires real metal, not contracts, and the physical vaults are running dry, while JP Morgan continued dumping paper silver. These industrial powerhouses stood firm and demanded physical delivery. That is why the price refused to fall. You can create limitless paper claims, but you cannot fabricate a 1,000-ounce silver bar. The fantasy of abundance has collapsed, replaced by the reality of scarcity. The paper market claims silver is worth $67. The physical market says it's priceless, because it can't be sourced. While the West plays financial games, the East is quietly clearing the table. For months, the Shanghai Gold Exchange has priced silver at a substantial premium compared to New York. That price gap acts like a massive vacuum. Every ounce of silver mined in Mexico or Peru is skipping New York entirely and flowing straight into China. The reason is simple: China pays more. But yesterday, buying from Shanghai accelerated sharply. They recognize that Western banks are exposed and vulnerable. They know JP Morgan is under extreme pressure, and by aggressively purchasing the dip, China is effectively tightening the noose around the American financial system, pushing Western exchanges toward potential default. This is not merely a trade, it is economic warfare. China is seizing control of the 21st century technology metal, and they're doing it by exploiting the West's own structural corruption. We already have a preview of what comes next. Recall the nickel squeeze in March 2022 on the London Metal Exchange. A Chinese billionaire amassed an enormous short position, wagering on falling prices. When the market turned, nickel doubled within hours, leaving him facing massive losses. What followed? The exchange shut down trading systems, erased transactions, and rewrote the rules to protect an insider deemed too big to fail. Do not assume they won't attempt the same maneuver with silver. As Monday approaches, the likelihood of force majeure or a trading halt has never been higher. The banks will not calmly absorb these losses. They will try to overturn the board entirely, but this time is different. Nickel feeds stainless steel. silver functions as money itself. If the silver market collapses, trust in the US dollar collapses with it. The system is trapped, facing either hyperinflation or outright default. Let's take a moment to dive into the technicals, because the math behind this is both elegant and terrifying. The reason silver could explode in price on Monday lies in a phenomenon known as a gamma squeeze, centered in the options market. Speculators have been piling into massive amounts of call options, essentially placing bets that silver will surge. The sellers of these options, banks and market makers. As silver inches towards $70, these banks are legally obligated to buy physical silver to hedge their exposure. The higher the price climbs, the more silver they must buy, and their buying drives the price up even faster. It's a vicious cycle, a runaway feedback loop. On Friday, they attempted to crush the price to escape this gamma trap. They failed. Now they head into the weekend, knowing that, come Monday, they may be forced to become the biggest buyers in the entire market, pushing the price against their own positions. Markets aren't just built on numbers, they run on psychology for over a decade. Silver investors have been bruised and conditioned to sell every time prices spike. But yesterday marked a shift in mindset. The fear of missing out, FOMO, has finally eclipsed the fear of losing money when a market no longer responds to bad news or manipulation. It signals a shift in trend that cannot be reversed. Retail investors, online communities, even sovereign wealth funds, they all smell blood in the water. They see the predator is wounded. This change in psychology is dangerous for the banks because it becomes a self-fulfilling prophecy. If everyone expects a gap up on Monday, no one sells. And if nobody sells, the price shoots toward infinity. The illusion of the all-powerful banker has shattered. Now let's talk about the elephant in the room. What happens if silver hits $100 at that level? The liabilities of the major bullion banks surpass their Tier 1 capital. In plain terms, they go bankrupt. They will need a bailout from the Federal Reserve. That bailout will involve printing trillions of fresh dollars, which fuels inflation and pushes silver even higher. As a perfect trap. JP Morgan's short position isn't just a poor investment, it's a systemic threat. They've essentially staked the Western financial system on the price of a metal that cannot be manufactured. Monday's market isn't just about silver, it's about whether the entire banking structure remains solvent. If control slips Monday, the collapse will spread to gold, bonds, and eventually to currency itself. So where does that leave you? With about 48 hours before the Asian markets kick off, the Friday smash has failed. The manipulation is crumbling. The beach ball they've been holding underwater for decades is about to shoot to the surface. The $67 price on your screen, that's just a shadow, a relic of a market already gone. This may very well be the final moment you'll ever witness silver priced in the 60s. Once the markets reopen, we step into unknown territory. True price discovery is about to begin. What's coming on Monday isn't speculation. It's a mathematical inevitability born from the collapse of the Friday manipulation attempt. The banks have exhausted their firepower, the vaults are drained, and the clock has run out. If you're not holding physical silver when the markets sound the opening bell on Monday, you're not a participant. You're just watching history's greatest wealth transfer from the sidelines.